Every year, over 80 lakh weddings happen in India, which is great if you own a sherwani, but it's even better for the economy because weddings don't just unite two people. They also unite gold, garments, gifting, catering, credit, cousins from abroad, you name it. And this massive celebration machine powers an entire parallel economy. And at the heart of this wedding industrial complex are two giants. You have Vedant Fashions Limited. Now, these are the folks behind Manyavar. And you have Raymond Lifestyle Limited, the menswear brand with tailoring in their DNA. And by FY25, the music had slowed down. Margins shrank, profits vanished, and stock price took a nasty fall. So what exactly went wrong? Welcome to Bottomline by Groww. In today's episode, we are decoding what's troubling Vedant Fashions and Raymond Lifestyle. And let's start with Vedant Fashions. Now, they're based in Kolkata and they're known for running India's most efficient ethnic wear machine. And their crown jewel? Manyavar. Now, they're so dominant in this groomwear category that it's practically become a synonym for sherwani. But Vedant doesn't just dress up the grooms. They also have Mohe, which is their bridal wear brand. They have Mebaz, which is family occasion wear. You have Twamev, premium festive wear. And you have Manthan. That's their more affordable offering. But what really made the company tick was its capital light model. Now, all their 678 stores, franchisee run. So on one side, you have Vedant handling the design, the branding, the supply chain, all the grunt work. And on the other side, you have local partners taking care of retail operations. And the result? High margins. You have consistently over 45% and a very lean working capital cycle. It's kind of a model that investors simply love. But here's a catch. This whole thing is running on dealer confidence. And by FY25, cracks started to show. You had slower footfalls, inventory was piling up, and the pressure was growing on their core metrics. In Q4 FY25, Vedant reported 367 crores in revenue and 166 crores in operating profit. By the looks of it, a margin of 46% is very strong, but it's down from 49% a year ago. And in this period, net profit dropped to 101 crores, and while revenue was still flat, costs jumped up, especially employee expenses and also promotions. Now, one key red flag was that the same store sales growth started turning negative. Now, that's like saying your regular loyal party guests have stopped coming to your party. So let's dissect. Why this slowdown? Now, first, the consumer sentiment remained weak through FY25, and given during the wedding season, the mid-premium shoppers were a tad cautious. Second, geographical track. Now, you had their key markets like AP, Andhra Pradesh and Telangana underperforming. And 3, new store additions. They added 27 in FY24 and these weren't delivering the kind of incremental growth that they were used to. And lastly, thinning margins. When brands like Mohe, that's the bridal wear side of things, and Twamev, their premium offerings scaled up, they diluted the gross margins. Now, they have the premium tag, but these are still in a ramp-up mode. That means more marketing, slower store productivity, and by and large, less efficient than Manyavar. So until these scale up fully, they're dragging their overall profitability. So what was once an asset-light, high-margin model is now under pressure as the groomwear demand is nearing saturation. So Vedant is trying to fix this. Now they've made some niche bets like divas and fragrances, but these are not big plays. They're still small. And cash from ops fell to 389 crores in FY25 and that's down from 478 crore rupees in the previous year. Now that means stretched working capital cycle, inventory and receivables rose, payables were flat and the net cash flow turned negative for the first time. Now remember, the market is more observant than your distant unwanted relatives. The market took notice and Vedant's stock corrected. And at one point, Vedant had traded at over 70x their earnings and that corrected more than 40% since its peak in December last year. It's now hovering around the 50x its price to earnings multiple. So with all these issues, what's Vedant doing? The company has said that they're slowing down on store expansion, refocusing on Mohe's productivity and trimming underperforming geographies and partners. Now, the management has also said that the Mohe stores, which were once 30% less productive than Manyavar, are now also on par. But their efforts to extend the brand into more everyday wear, these are still early stage experiment. These are not really proven growth levers by any measure. So that's Vedant for you, an asset-light model that's now navigating a market that's no longer as light on its feet. Now, let's turn our attention to Raymond's Lifestyle, and this is an entirely different beast. So while you have Vedant's challenge to stay efficient, Raymond's is to manage the weight of their vertically integrated, cost-heavy structures. And let's take a closer look here. Now, Raymond portfolio includes their Raymond Fabrics. That's their OG business. They have Park Avenue, there's Color Plus, you have Parks, and you have Ethnics. Now, Ethnics is Raymond's ethnic wear offering. See, until last year, that's 2024, Raymond Lifestyle was a part of Raymond Limited. Then there was a demerger to really create a leaner, sharper, more fashion-focused company. Now, this business also includes a garmenting export arm and a high-value cotton shirting division. And in total, they operate around 1,600 stores. That's a combination of both CO, company-owned and franchised outlets. But Q4 FY25 was brutal. Revenue was a dab short of 1,500 crores. It came at 1,494 crores. But operating profit collapsed to just 14 crores. Now, that's a 90% sequential drop, enough to make even the best fitting suit suddenly feel loose. But net results was a 45 crore rupee loss, with margins coming at 1%. What happened? See, one major setback was a ransomware attack in February this year, February 2025. Now, that disrupted a whole bunch of things. You had billing, logistics, production, all these disrupted for near a month. And in a business that's like running on daily volumes, this is a huge blow. In short, hawa nikal gaya. And recovering from this drained financial operational resources and it dragged sales and inflated costs. Look, they were already under pressure. You had revenue growth that had slowed and the 170 new stores added in FY25 weren't scaling fast enough. And add to that, you have Ethnics, their ethnic wear bet, that also hadn't scaled enough and performed. But amidst all this, right, their export business and fabric segment remained stable, but this wasn't enough to really carry the recovery. And in branded apparel, margins 0.4% in Q4. Why? You can kind of work this out. Weak sales, high fixed costs from new stores and elevated ad spends. Now, suddenly, Raymond's massive retail footprint is now starting to feel like a liability in this sluggish market, which is why they are looking to pivot to a franchisee-led strategy for more flexibility and reducing overheads. Now, this is more than just a cost cut. It's how you're going to stay agile in a fragile demand environment. Because when you're vertically integrated and volumes fall, your fixed costs are not going to flinch. They're going to flatten your margins. And add to this bad timing. Just months after the company was spun off to unlock value, there was a ransomware attack. Just to be very clear, there's nothing like a good time for a ransomware attack, but just that in this case, when it rains, it pours. This attack came in months after the demerger, and this is at a time when the market really wants clarity, moment, stability. And while the attack might have been one-off, it kind of revealed deeper structural issues. Too many brands, too many stores, too much overheads, and not enough pricing power. Now, Raymond's branded apparel segment, which was once its urban growth engine, it's barely moving. Now, interestingly though, Raymond Lifestyle's FY25 operating cash flow came in strong at 404 crores, which is up 38 crores from the year earlier. But you dig deeper, there's a catch. This was a defensive move. They slashed inventory and delayed payments. And when you do this, right, you're kind of generating a short-term cash boost. So this is not from higher earnings, but from spending less. Net cash flow improved to 182 crores, giving them a temporary breathing room. But unless you have sales and your margins are recovering, this cushion will erode fast. Also, post-demerger, the Raymond Lifestyle stock has tanked over 60% until last month. That's May 2025. And then questions also started popping up about their leadership. Now, in December 2024, you had two corporate governance advisory firms asking shareholders to vote against Gautam Singhania's proposed appointment as the executive chairman of Raymond Lifestyle. Now, they flagged concerns about the role being announced before the board approval. There was a lack of clarity on his pay structure and also really broader questions around the long-term strategy. And well, some reputational risks from his personal life totally didn't help. But shareholders eventually approved that appointment, and this entire episode kind of raised fresh questions on governance at a time when what this company really needed was stability at the most. So, what's Raymond Lifestyle doing to improve its performance? Closing down 10 to 15% of underperforming stores. So they're closing down 10 to 15% of their underperforming stores. They're switching to franchising models. They're betting on ethnics, innerwear, and sleepwear. Now, their export growth is another focus with plans to expand to the Europe and Middle East areas. But for now, recovery will be slow and cost-led, and it's not going to be a sharp rebound. And what's the investors' takeaway? Well, turns out that the only guaranteed thing at Indian weddings isn't the buffet, it's business risk. And while the celebrations are going on, investors here are learning that even iconic brands can hit a rough patch when costs rise and Janta ka moods shift. Now, Vedant is struggling to scale, Raymond is dealing with their post-demerger wrinkles, and both of them are waiting for margins to smile brightly. We'd love to know what you think. Drop us your thoughts in the comments. And for more such insights like this, subscribe to Bottomline by Groww. Because in the world of investing, staying well-dressed is optional, but staying well-informed, that's non-negotiable.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.